otherwise known as FUTA, F-U-T-A, Federal Unemployment Tax Act. So this is another law that was passed way back when, in the 30s, I believe it was, during the Great Depression. Obviously, we had very high levels of unemployment during that time, upwards of 25%, and there was no social safety net in place to ensure that those individuals didn't then starve and lose their homes and all of the bad things that happen when people lose their jobs. So the Federal Unemployment Tax Act was instituted as a way of helping to remedy in the future any economic downturns. So within this chapter, we're not only going to talk about the Federal Unemployment Tax Act, we are also going to talk about what's called SUTA. So the only difference between these two, the F and the S, federal and state. Okay, so there are two different pieces of legislation that work in conjunction with each other. This one is the federal, and this one is the state. Now, the federal unemployment tax applies to everybody in the United States, regardless of what state they're in. State Unemployment Tax Act applies on a state-by-state basis. Now, every state has some sort of unemployment system, but each state can do it differently. They do have those systems, or those, the state systems do have to be approved by the federal government. They have to meet certain guidelines, but states have a lot of leeway in how they want to set that up, including what they want the tax rates to be, and what types of benefits unemployed individuals will receive, how long they will receive those benefits, what the criteria are for receiving those benefits. So each state has its own type of system. Like I said, they work together in conjunction with each other. The federal unemployment tax essentially oversees the different state unemployment taxes. The actual benefits that individuals receive don't come from the federal government. Now, over the last couple of years with COVID, there were some exceptions to that. There was some special legislation that was passed where the federal government actually did provide a lot of those benefits, direct benefits. That is not the case anymore. That was temporary legislation. Now it's gone back to the old method of where it's just the states that pay those benefits. So if an individual receives a check, an unemployment check, or some sort of unemployment payment, they're getting it from the state. They're not getting it from the federal government. The federal unemployment tax that employers pay simply helps to administer the program. So it covers administrative costs to ensure that all of the state systems are functioning as they're supposed to. Okay? As a result, because these are two separate taxes and they are applied differently, we've also got different tax rates that we're dealing with. So the federal unemployment tax has one tax rate, applies to everybody, all the employers in the U.S. But like I said, each state has their own state unemployment tax, and so they also have their own tax rates that they apply. You'll see as we go through that employers, and this is a tax that's only on employers. Employees don't pay any portion of it, except for, I think there is one state where the employees do pay a portion of the state unemployment tax. There are also, I know California has a state disability program that they kind of couch under the unemployment program, and that's a separate tax as well, and that is shared by the employer and the employee. In Iowa, employees do not pay anything toward either one of these taxes. No employee pays anything toward the federal. It's only the state unemployment where employees in rare cases in specific states might contribute a part of that. For our purposes here in Iowa, it's only employers that pay this tax. So there's not going to be any amount withheld from employee paychecks for either one of these taxes. So we're just looking at it from the employer's perspective. We're not going to go into details in this chapter about benefits. The benefits that are received, well, first off, I really don't have the knowledge to know what they are at this point or how that's all determined, other than we will look at what the maximum benefits are and the amount of time that those benefits can be paid. And I think there's a chart in your textbook that also gives a summary for each of the states. Now remember, all of these numbers are from 2021, so 2022 numbers may be different and probably are different, because one of the things a lot of states did was during COVID is they expanded the number of weeks that unemployment benefits could be paid. But then a lot of states retracted those once we kind of got out of the whole pandemic. Okay, so we're going back to the start here. We have to talk a little bit again about who is an employer, who is an employee. Now the good news is pretty much the same definition as we talked about under Social Security and under federal income taxes. But we do have to just kind of be reminded of what that definition is. Also, we've got to define what wages are for federal unemployment taxes. For the most part, they're the same as wages under Social Security or federal income tax. Then we're going to compute that federal income tax. There is a credit. This is, and I'm just going to give you a heads up. This is where students have the most problem with this chapter, is when we start talking about this credit. There's a credit against the federal unemployment tax. Credit meaning it's reducing the tax rate if the employer is eligible for the credit. Okay? So it's reducing the tax rate and it reduces the taxes. This is just for federal unemployment tax. Then we're going to move into talking a bit about the state unemployment tax and how that all works and how it ties into that federal unemployment tax system. We've got a separate form that we've got to fill out. So we've worked with the 941 and we're pretty much finished with the 941, but now we have another form that we have to fill out. It's called the Form 940. It's very nice of them to make give these forms names that are very similar. Wouldn't want to get those confused, but the Form 940 is what we're going to use for federal unemployment tax. Now, states have their own forms as well. The 940 at the federal level is filed on an annual basis, and we're going to go through all these details again as we get more into the chapter. But just as a preview, the food tax form, the Form 940, is filed annually, once a year. So it's not a quarterly form. However, the state forms are filed quarterly. Okay, so they have to be, so we kind of have two different schedules here for the state unemployment tax. And that's where we're going to talk about we'll take a look at the Iowa state unemployment form and how it's done. Questions about what we're going to be discussing? Okay. Kind of already went through a lot of this. Passed in 1935. It's a tax that's only imposed on employers. We're talking FUTA here. The funds that are collected are used to pay the cost of administration for the program, for the overall federal and state unemployment programs. SUTA, state unemployment. State unemployment laws dictate how much is to be collected. Each state has what's called a trust fund. So all of the money that's collected at the state level from employers goes into a pool, and then benefits are paid from that pool. But employers, each employer is kind of monitored. All of the claims against employers they keep track of them. And so employers that have a lot of claims against them draw more from the pool, right? From the pool of funds. Those employers that don't have any claims against them, maybe they don't have a lot of turnover, they're pretty steady with regard to their employment status, they aren't drawing anything from that pool. So those employers that draw more from the pool are penalized in the form of higher tax rates, called experience rates, that they have to pay. And those rates are based on the wages that they pay to each employee. Okay. All states, Puerto Rico, Virgin Islands, and District of Columbia have unemployment compensation laws. Again, it has to be approved at the federal level, administered by the Social Security Administration, but the federal government has to approve all of those plans. And the benefits are paid under each state's individual laws. But remember, those laws and how they're set up have been approved by the federal government. All right, so who is covered under FUTA? Employers have to pay it if either of these, and this is an or, not an and, either of these two tests apply. So if they pay wages of $1,500 or more during any calendar quarter in the current or preceding calendar year. So if any employer that has paid that amount of wages per quarter, not per year, but per quarter, in any of the quarters currently, so that would be any quarter in 2022, or they would look back at 2021. They paid that. Or they employ one or more people on at least some, this is where it gets a little tricky, on at least some portion of one day, even if that's 20 minutes, in each of 20 or more calendar weeks in the current or preceding taxable year. Don't get too tripped up on those requirements, but that's probably one of those is probably going to apply to most employers in this country. And then they go on to just kind of define, well, what's a calendar week? 7 successive days, beginning with Sunday. 20 weeks do not need to be consecutive, so it could be 1 week here, 1 week there. So if it adds up to 20 weeks, they don't have to be the same employees. Could be, different employees that make that up. Regular, part-time, temporary are considered employees. So it's a pretty broad definition of what's considered to be an employee. If you meet one of those standards, you are subject to federal unemployment tax as an employer. Employees on vacation or sick leave are still included as employees. Members of a partnership are not considered to be employees. I think we've talked about this before when we were talking about those who are subject to Social Security taxes and federal income tax withholding. Partners in a partnership are not considered to be employees of that partnership if they're partners. Now, partnerships can have employees, partnerships can employ individuals, but those individuals would not be partners. They would not be owners of that partnership. But if you are a partner in a partnership, you are not considered to be an employee, so you are not subject to Social Security tax withholding or Medicare tax withholding. You're not subject to federal income tax withholding, and you're not subject to federal unemployment tax, and you wouldn't be subject to state unemployment tax either. That is not to say you're not subject to those taxes. It just means that the employer is not going to withhold them from your paycheck. Federal income taxes, though, any amounts paid to partners would not be subject to federal unemployment taxes. taxes or state unemployment taxes. But those partners and partnerships are treated like self-employed individuals in that they are responsible for their own Social Security, Medicare taxes, and federal and state income taxes to be paid. All right. Again, we're going back to that common law definition. So, and all of those aspects of control that help to drive and determine whether an employee or whether a worker is considered to be an employee or a contractor. So, just like with Social Security and Medicare tax, just like with federal income tax withholding, if the individual meets the definition of an employee due to those control aspects, then they are considered an employee for federal unemployment tax as well. If they don't, then they are contractors. They're not subject to, the employer is not responsible for paying federal unemployment tax or state unemployment tax on their behalf if they're independent contractors. So there are some exceptions. Individuals who might meet that definition of employee, but they are they meet one of these exceptions to it. So casual laborers, so individuals who are just like day laborers would be an exception, not subject to the unemployment tax. Partners and directors of corporations, again, partners of partnerships, directors of corporations. Foreign students, exchange visitors would not be considered employees for purposes of federal unemployment tax. Students enrolled full-time in an internship program are not considered employees for federal unemployment tax. Independent contractors, I already talked about that. Home workers, so individuals, certain home workers would not be. Full-time life insurance salespeople, and government employees of international organizations, such as the United Nations, would be considered, they would be exceptions to the list of individuals. Even though they're employees, they're not subject, they're not employees for federal unemployment tax purposes. We pretty much have the same definitions of who's covered under FUTA as who would be covered under SUTA. There are some, as I mentioned, there's some minor variations within states. We're not really going to talk much about any of those variations. So they use this ABC test to determine exclusion. So if the worker is free from control and direction, so we go back to that control, behavioral control, financial control, all of that. If the work is performed outside the usual course of business, that means, let me think about it, see if I can think of an example here. Okay, so I am a faculty member at DMAC. My job and what I get paid for as an employee is to teach accounting. Well, if I am also then going to be, maybe they're going to pay me to do some janitorial work. That's outside of my usual course of business, right? So I'm doing something different, and I'm not doing it on a regular basis, then that part of whatever I get paid for that would not then be considered wages for purposes of SUTA. Okay. Also, if the worker is customarily engaged in an independent trade or business. So the janitorial staff actually is a pretty good example here. We have employees here who are janitorial staff. That is their job. That is what they get paid to do as employees by DMAC. Now, if DMAC were to contract with a private company that provides janitorial services, or maybe they contract with an individual who not only provides those services to DMAC, but they provide those services to other businesses in Ankeny, then those individuals would not be considered covered under DMAC's SUTA because that is an independent trade or business for them. Okay, so again, we're going back to employees. This only applies to individuals who are considered to be employees. Questions so far? I know I'm talking a lot here.
Where was the A?
What's that?
Where was the A for the, it's called the ABC test.
I have
B
no
for-
idea. I know, it's kind of weird, isn't it?
B, business, alright, sure, I guess. C, control, okay. Where's the A?
I don't know. Good question. Not a very good acronym for describing it. Okay, so a lot of employees will work for companies that are not in one particular state, right? Think of Walmart. Walmart's all over the place, right? So when Walmart pays when they pay their federal unemployment tax, that's easy, right? It's going to be everybody that is a U.S. employee. It's going to apply to all of those employees. But what about on a state-to-state basis? So, Walmart has stores in every state. How do they determine which state they're going to be paying the unemployment taxes to? So there is an order to determining that, and it's based on the employee, how the employee and where the employee does their work. The first factor would be the place where the work is localized. So if you've got a Walmart employee, they work at Walmart I assume there's a Walmart in Ankeny somewhere. Walmart in Ankeny, then their work is localized in Ankeny, which would be in the state of Iowa. That would be pretty easy. Well, what if you can't determine where their work is actually localized? What if they're like a manager that travels to different stores, or a regional manager, and they kind of spend equal time everywhere? If they have a base of operations, so maybe they have a main office, then that is going to define which state unemployment tax system they are subject to. If they don't really have a location or base of operations, the location of the place from which operations are directed or controlled. So maybe Arkansas, right? Isn't that their headquarters are in Arkansas? So if that regional director doesn't really have a localized place where the work, a place where the work is localized, doesn't really have a base of operations, then we might look at the third factor here, where the operations are directed or controlled from, right? If we still can't determine that, maybe they've got several managers and they're all equal and they live in all different states, then the location of the employee's residence would be the determining factor. So this helps for the company to determine under which state unemployment tax system the wages for that employee should fall, right? So if we're talking about somebody that's a regional director and they cover Iowa and all of the states surrounding Iowa, trying to determine, okay, well, do the employee's wages fall under the umbrella of Iowa's state system, or Missouri's, or Illinois, or Minnesota, Wisconsin, any of those states surrounding Iowa? These are the factors in this order that determine which system they fall under. Okay. Now, if by chance you still can't determine under which system, there is a reciprocal coverage agreement that can be applied. There is, and it's the states will enter into this arrangement. The employer can elect coverage of the employee in one state, one of those states, as long as it's within those states that have agreed to this arrangement. So the benefit is the employer can choose a state in which all services of interstate workers are to be covered. That's a big advantage because guess what? The tax rates are different in different states. And you'll see there are other factors that are different in each state, including the amount of wages that are actually subject to taxation. So the employer could choose a state that has much more favorable tax rates and wage bases. Once they choose, the employee does have to consent, the state, and they have to get approval from the state as well. If the employee is transferred to another state during the same calendar year, the wages covered by the unemployment compensation law of the previous state will be included in the taxable wage base. And we'll talk about taxable wage base and what exactly that means when we get into the calculation of the federal and state unemployment taxes. But essentially that means that if, I worked in Iowa for half of the year and then I was moved with the same company to Missouri, my wages just continued. I'm being paid by the same company. My wages that were paid to Iowa will be included in the wages that were paid, that would be subject to the tax in Missouri. So they don't lose it. They don't have to pay that tax. They don't have to start from scratch when the employee moves to a different state. All right, I see you're all getting ready here. Is it time? All right, close enough. On Thursday, we'll continue with this. Where are we here? We'll start off with the Americans working overseas. This one's pretty easy. And then we'll start getting into the calculations as well for FUTA. Okay, questions? All right, that's it.